Welcome to Mortgage Markets and More. I am your host, Peter D'Angelo from Rate. I hope you're doing well and having a great start to your year. It's been a bit of a rocky road as far as interest rates are concerned. There's quite a few updates that I'm going to share with you. Some stuff going on with the economy that's very important for us in the real estate world. And then today's episode ends with a Did You Know segment that is extremely educational, particularly for first-time home buyers. But if you currently have a mortgage, maybe I'll be sharing some information that'll be helpful for you as well. Without further ado, let's get into where currently mortgage rates are. According to Mortgage News Daily survey, as of recording this podcast, the Thursday before its release, the 30-year fixed rate mortgage is averaging 7.17%. The 15-year fixed rate mortgage is currently averaging 6.54%. The 30-year jumbo fixed rate mortgage is averaging 7.39%. The 30-year FHA mortgage is averaging 6.5%, and the 7/6 SOFR adjustable rate mortgage is averaging 7.01%. Overall, everything is up slightly, except for the one outlier, which is your 30-year fixed rate mortgage. That saw the biggest increase week over week from last week's episode. So overall, interest rates are going up. Let's take a look at the bond market as we customarily do. The 10-year is yielding currently 4.673%. The 5-year yield is at 4.453%, and the 2-year yield is 4.276%. I'd like to just have another quick reminder on this. We look at the bond market because that is closely tied to mortgage financing costs. It's an assessment of the projection of the value of money in the future. So bonds are U.S. debt that gets issued for people to invest in. That's a way that the government's able to fund their debt, and the projections of where the value of that bond will be in the time horizon as outlined. So 10 years from now, 5 years from now, and 2 years from now. We have been in an unprecedented environment for a number of years where the yields were what they call inverted, where you see the shorter term treasury yields being higher. So higher value in the short term than long term, which is kind of counterintuitive. Normally that does kind of flash, and people have been calling for a recession for a while. That flashes before recessions historically, but it's not necessary before a recession. It's just that if you look back, you can see, oh, well, we saw an inverted bond yield curve where you have the shorter term yields yielding higher than the longer term yields. That has since now flattened out over the past few weeks. And if you've been listening to the show, the 10-year yield has gone on a big run up, and that really has a big impact on your financing rates. And as we saw from the mortgage rates, they've gone up. So let's talk about why. Why did mortgage rates go up like they did? To reiterate, the Federal Reserve has cut their benchmark lending interest rate a total of 1% since they started cutting in September. I know I sound like a broken record, and the reason why I keep bringing this up is the news is talking about the Fed rate cuts, and I do receive calls and texts pretty often asking me, oh, Peter, rates are lower now because the Fed cut, and unfortunately, I have to be the bearer of bad news, which sometimes I do more regularly on the podcast here. But unfortunately, that hasn't translated into the market because the market is very speculative. So it's about where interest rates are going and what that looks like. That's what we're going to get into now, some of the why behind where the interest rates are today. First and foremost, we have the ADP employment report that was furnished this week that showed slower growth, 122,000 jobs added. That's versus the forecast of 215,000 jobs added. And the prior figure was 211,000 jobs added. So it shows a little bit of a weakness there, according to ADP. Job openings, on the other hand, we got that survey. It's called the JOLTS, Job Openings Labor Turnover Survey. That came back showing 8.1 million jobs. So that was against a forecasted decline where they were expecting the job openings from the JOLTS report to be 7.7 million, and it came in at 8.1 million. So that did go up quite a bit even compared to the prior reading, which was in the high 7 million range. So that's showing us a mixed picture, that ADP showing slower jobs added, but then we have the job opening labor turnover survey that jumps up. For context, historically, it's pretty common that we see this happen around this time as people are assessing their employment toward the end of the year and setting up the new year. This JOLTS survey reflects that, and it's customary in the new year, people shifting around, finding new employment, things like that. The other component we look at every week and I report out on is the initial jobless claims. These are people filing who have lost their jobs, and this is the claims report that we get every week. And that came in lower than expected, 201,000. The forecast was 215,000, and it was just above 200,000 last week. So between the JOLTS and the initial jobless claims indicating a stronger job market, then you have the ADP. That's the outlier in the data. Markets aren't paying attention to that very much. The reason why we look at this information is because the Fed is very focused on the dual mandate. Again, I sound like a broken record, but this is very important. The Fed looks at inflation and the economy, particularly jobs. As they had a higher benchmark interest rate, 5.25% to 5.5%, before they started cutting in September, was one of the higher Fed benchmark interest rates that we've seen in a while, albeit because 2008 had dropped their Fed fund rate down to zero for a very long time, and it created a lending environment that's not normal and not customary. So now, as things have happened since COVID, with inflation running up, they raise that rate so they can tamp down inflation, but they have to be careful. They want to bring down inflation, but they also don't want to have negative impacts to the labor market. So that's why we look at this data every week, and whenever it gets reported out, this is what the Fed is going to be looking at. Speaking of which, this week we received the minutes from their last Federal Open Market Committee meeting, which was toward the end of December. As expected, it's varying opinions, but overall, the picture that we're being painted from these minutes is that the Fed is now being more cautious. There was a lot of optimism about Fed rate cuts going into 2024 a year ago, and now going into 2025, it's the opposite. And it's really a function of the fact that inflation isn't going down consistently. We're seeing these pop-ups, and it's showing to be what they're calling stickier. So inflation isn't going down, and it's sticking around and has these moments to pop up. And the Fed is concerned, or there's at least concern in their perspective when they're setting their monetary policy, that cutting rates too quickly could create more inflation again. And they don't want that to happen. So the job market being stable, not really a reason for the Fed to cut interest rates. Inflation ticking up a bit, not a reason for the Fed to cut rates. I was in the camp when we talked at the end of the year before the Fed Open Market Committee meeting. I wasn't really on board with a Fed rate cut because the data wasn't there. It wasn't showing. We saw inflation ticking up. The job market was still showing to be pretty strong. So with those two things, but what had happened, the Fed made their rate cut. It was a unanimous decision, but there's some dissent in the perspectives currently. So right now, I'll say again, from that meeting, Fed Chair Jerome Powell communicated that they're expecting 2 rate cuts this year. I would not have expectation for cuts earlier in the year, and it's going to be up to the market, really, that's going to create our lending environment as we go into the new year. I wanted to explore an idea with everyone today because we're in the new year and inventory is still historically low. It's trending in the right direction, but inventory is still low, and there's a ton of demand that keeps increasing with every passing month, with every passing year. There are more would-be home buyers that are either priced out of the market or there's not enough inventory available. Inventory, I mean homes available to purchase, homes listed for sale. So I'm going to talk now more particularly here to the North Jersey real estate market. I am seeing now that more homes are being listed. Why does this happen? We have the holidays. Nobody really wants to list their home around the holidays and have to contend with balancing family calendars and schedules to set up showings for their home while they have it decorated, while they may be hosting. So when the calendar flips to January, it is common that we see a little tick up, which is happening. Just from my survey and assisting families and clients as I do every day, I'm seeing that there's quite a bit that's coming on the market, which is great news. This isn't a spring market, we're still in January, but to know that there's more inventory gives me some optimism looking at the year ahead, and maybe we're going to see. It could be a component of would-be sellers are, swallowing the pill of reality that this is the rate environment. If you're waiting for interest rates to go down to 3%, that's not going to happen. 4%, I don't believe that's going to happen either. So this rate environment is what we have. And people who need to move, who have been waiting for a year, 2 years, maybe even 3 years for family purposes to either downsize or upsize, now they're going to go and list their home. So we're starting to see that trend develop. The other thing is there's a bit of a holiday hangover that happens. So even though we're seeing some more inventory happening right now, as we go further into December and into February, given the volume of inventory that's picked up here in North Jersey, I'm optimistic that we're going to see a little bit more even happen when we get closer to February because of that holiday hangover. People are spent, the holiday being in the middle of the week, particularly for Christmas and New Year's, that really kind of threw a monkey wrench in. And what day is it? I can't tell you how many times I had those types of conversations. So when people now finally get their bearings in the new year, then we may see another uptick in homes listed for sale. So keep your eye on the market. If you're a would-be home shopper, keep checking on your, platforms of choice. Shameless plug right now. I'm excited to share that the Rate app, which is from our company, actually has a functionality in it now that you can search for homes, which is pretty cool. And with a built-in calculator for your mortgage, you can kind of in one spot have a very sharp idea and then communicate directly with me if you're interested in a pre-approval, if you're interested in me providing you any insights on any properties you may be interested in. It's all there within our Rate app. The link for that Rate app is in the episode description below if you're listening on any of the podcast platforms. Now on to our Did You Know segment for today, which is going to be primarily educational. We are going to talk about escrow accounts. Before I go into that, I'm going to make a note. If you make a deposit on a contract when you're purchasing a home, there's an escrow established. And normally that's held by an attorney or a real estate company that's managing that transaction. That's part of your deposit on the contract. That's part of your down payment. That is not what I'm talking about. What we're going to be talking about today are escrow accounts for purposes of servicing your mortgage, particularly taxes and insurance related to your property. So for the first-time home buyers out there, starting out, when you close on a home, you're going to be making payment at closing for prepaids and putting money into an escrow account. The prepaids are going toward paying things like your first year's annual homeowners insurance premium. You are required to pay for that at closing. That secures your insurance policy for the next 12 months in that property. So now you know, and the lender's aware and has that policy on file to know that you have insurance on your property. Great. If you don't have insurance on the property, or if you let that lapse for whatever reason, then the lender has to do what's called forced place insurance. That's not a situation you want to get in. When you escrow taxes and insurance in your mortgage, you don't have to worry about that. The mortgage company, the mortgage servicer, has money that is going to be paying that, and you're setting up that account at closing. The other element of prepaids is taxes. You will be making a payment for taxes, some sort of prorated amount, depending on the state. I'll talk to New Jersey. This is where I primarily do business. We have quarterly taxes in this state. So that means when you're closing on your home, you're either going to be paying for the next quarter of taxes at closing if it's due within 60 days, plus any per diem, so any per day cost of what taxes would be from when you take ownership of the property to the end of that tax quarter. And you're reimbursing the seller essentially because the seller would have already paid those taxes, or they may be paying it at closing, so it's a function of the numbers there. Now we're going to actually get into the escrow account part. It's not prepaids. This is setting up the account that will hold the funds for payment of your taxes and insurance into the future. Here are a couple quick notes on that. Number one, you will be putting in a 2-month buffer. Lenders are allowed legally to hold a maximum of 2 months worth of taxes and insurance in that escrow account to ensure that there are funds available to make payment on taxes and insurance moving into the future. As we all know, taxes and insurance go up. So to avoid there being a shortfall or to avoid there not being enough money to make payment on taxes in the future, if there are increases, they have that buffer established. Secondly, your mortgage servicer is the one that manages that escrow account. So when you get your mortgage statement after you close, you will see that there. You will see what the balance is. You will see on your mortgage statements when payment is made for taxes and insurance. That's the transparency that's provided to you so that you're aware of what's being paid for your property. Thirdly, you'll notice that there may be another month. So you may have 3 full months of taxes and insurance being collected into your escrow account. The reason for this is that mortgages are paid in arrears. So you're going to pay at closing your closing costs and down payment, and you're going to close. Let's say you close toward the end of the month. Let's say it's January 28th and you close. Your first mortgage payment will not be due until March 1st. So you're prepaying the interest to the end of the month. We've talked about that on past episodes, but you're also putting that 1 month for February into that escrow account so that when you get to January of 2026, you will have 12 months of homeowners insurance that's in the escrow account and ready to make payment. For taxes, that will depend on where we fall in the quarter and whether or not you're going to need to put that extra month in there, or if it's just going to be a 2-month buffer if you're paying for the next quarter at closing, if it's due within 60 days. Every year, your lender and mortgage servicer is required to provide you with what's called an annual escrow account statement. This shows you what the current balance is, and they are legally required to let you know if there's a shortfall based upon what the updated taxes and insurance figures are for your property. If your insurance premium goes up, if your taxes go up, you may be required to add money into your escrow account. This is important, and this is a common question that I get. If you have a 30-year fixed rate mortgage, it's the most common mortgage, your monthly payment's not going to change for your mortgage. Principal and interest, your rate of financing is fixed, your monthly payment is fixed. However, when you're escrowing taxes and insurance, part of your monthly payment is taxes and insurance. And if those go up, your mortgage payment could go up. So that is one part where you could possibly see a change in your mortgage payment. When you get this annual escrow account statement from your mortgage servicer, it's going to notify you of any shortfall. If there's a shortfall, then you have 2 options. Option number 1, you can make a lump sum payment so that you can pay up your escrow account so there's sufficient money for the 2 months reserves for taxes and insurance, buffer we'll call it, and then also enough for payment moving forward. The second option is if you don't want to make a lump sum payment. A lot of times this is the automatic option that most servicers default to. You have the opportunity to spread out the payment for funding that escrow account over the next 12 months. And that will increase your monthly payment. And if you do that, there could be a little bit of a doubling effect of how much that's increasing your payment, or a compounding effect, I should say. That will mean that if your taxes and insurance have gone up, then the amount for taxes and insurance that's being collected on a monthly basis is going up because it's higher now. And then on top of that is the additional charge, or collection rather, of the money that's required for your escrow account. So you can really see probably a little bit more of a meaningful increase in your monthly payment if you elect for that second option. So that is the highlight reel of escrow accounts for you. That is also it for me for today, for the show. I hope you found this information helpful and useful. If you have anything you'd like me to deep dive on, or if you have any questions about anything that was covered on today's show or past episodes, please reach out to me. My email address is peter.d'angelo@rate.com. I welcome any feedback and would love to hear from you. Follow me on socials if you'd like. You can also subscribe on Spotify, Apple Podcasts, And there's a YouTube channel where you can watch the video for these episodes. And I am working diligently to start getting these Did You Know segments put into a playlist on my YouTube channel so that if you do want to check out any information just from the Did You Know segments, you will have an opportunity to do that, and there will be a place for that. I hope you all have a wonderful rest of your week and have an awesome weekend. I look forward to giving you an update next week. In the meantime, take good care.